Okay, so now let's go through some of this key economic data that's released throughout our trading week. Now, as I said, a country's currency is generally speaking a gauge of the country's economic standing. Now, at the centre of any particular country's currency is the central bank. Okay, now every country has one. The central bank has the power to set interest rates. And it's the interest rate levels or the projected interest rate levels that ultimately dictate the value of a country's currency. Simply put, interest rates are set to control a currency. If interest rates are going up, it usually means that the currency will get stronger, as investors will buy into that currency and invest to get a higher return. Now, the central banks around the world are generally mandated to control inflation. They're also mandated to control employment. But we're going to be looking here at inflation. Inflation, I put this band here around the central bank. Everything that the central bank do has got its eyes on inflation. The inflation story basically dominates what the central bank policy is. Now, most central banks are mandated to keep inflation at around 2%. Think about it for a moment. If interest rates are high and going up, it encourages savers to save more money. It also encourages borrowers to borrow less money for them to spend. If interest rates are low, it basically means that people can borrow more money. And if people are borrowing more money, what are they doing? They're spending more money. And if they're spending more money, what's happening to prices? Prices go up. It basically means inflation is heading higher. So interest rates may have to move higher to protect their inflation targets. Now remember, inflation isn't a bad thing. 2% inflation is considered healthy for an economy. Anything above 2%, 3, 4, 5, you get into hyperinflation. That's not good for an economy. Basically means the dollar in your pocket is going to be worth less. It means the country will ultimately go into recession and contract. Inflation at 0% is also considered unhealthy. It basically stifles investment. People don't spend today because they think they can get it cheaper down the line. Businesses won't invest in the future because there's no real gain because the economy isn't growing, so they'll hold back on their investment. Okay, so let's now look at some of this data. Top of the list, how do we measure inflation? Well, the key indicator that is released once a month is called the CPI, and it stands for Consumer Price Index. It's basically inflation. It basically shows you what's happening to prices at the consumer level. This is released, as I say, once a month, and it's keenly awaited by the markets to see what's happening to inflation. Is the central bank policy keeping inflation near to target? Is it overshooting or is it undershooting? Then we've got producer prices. Producer prices comes out again once a month, gives you an indication of what the producers, the people that are manufacturing the goods and services, what they're paying for prices at the producer level. Okay, again, a good indication of what could be happening, because obviously whatever the prices increases or decreases, they will pass that on to us, the consumer. So it could be a leading indicator on where the consumer prices may be as well. We'll just go round the list here. Retail sales. Now, retail sales is a key indicator. Retail sales basically tells us what you and I are spending on the high street or online or what have you. It's basically telling us, are we spending money? If retail sales are going up, it means we're all spending money. And if we're all spending money, what's happening to prices? Prices go up. The CPI goes up. Interest rates may have to follow as well. So we keenly look at the retail sales number. Now, another indicator we look at is called the PMI, and it stands for the Purchasing Managers Index. Now, the PMI indicators are slightly different than the other indicators in that they are leading indicators. It's basically a survey of business leaders in the different sectors, the manufacturing, the construction and the services. They basically do a survey of these business managers and ask them about their outlook. Are they going to be employing more? Are they confident? And basically anything above survey reading of 50 is considered that it is an expanding economy. Anything below 50 means that the economy is actually contracting. So we always look at PMIs. They're a good leading indicator. They come across the developed world and keenly awaited by the market participants. So do keep an eye on those. Another one I want to talk about, probably the most important number that comes out in the calendar month, and that's the employment number. Everything focuses around employment. If people have got jobs, what are they doing? They're getting more money, they're spending more money. What's happening to prices? Prices go up, inflation goes up, interest rates may have to follow. Where interest rates go, so should the currency. So the number that comes out of the USA is called NFP. It stands for non-farm payroll. Most keenly awaited data out in the calendar month. It's usually on the first Friday of the month. I in fact stream it live, trade it live for our room as well. Do check it out if you haven't already done so. And this bunch of data is also accompanied by the average earnings. It tells us basically, are people earning more money this month than they did last month. Of course, if people are earning more money, their wage packages are going up, means they're spending more money. They've got more money to go out there and enjoy the things they like. If they're doing that, then of course prices go up, inflation goes up, central banks may have to move interest rates. Where interest rates go, currencies should follow as well. So we're always looking at the employment data in the different economies around the world. Durable goods, that's another one. Durable goods are basically, we used to call them the white goods, like the washing machines, the dishwashers, the big ticket items. Not something you'd buy every month, every year necessarily, maybe something you'd do every 2 or 3 years. These are the big ticket items. If you're confident that you're going to have a job, if you're confident that everything's going well, then you might go out and buy these big ticket items. These big ticket items is a gauge that if you're spending money, prices may go up as well. So durable goods is a key indicator that we look at as well, the big ticket items. Next up, we have GDP, gross domestic product. Key indicator, basically tells you the state of the economy. Is it expanding or is it contracting? USA, for example, at the moment have a GDP of around 4.1%. The country is growing at about 4% year on basis growth. So we're always looking at that. If the economy is expanding, then of course that personally means inflation is going to push up higher. Inflation pushes up higher, then central banks may have to act on interest rates. Housing data. Now, housing data is a key indicator. Obviously, these are the big ticket items. You don't go out and buy a house if you've lost confidence in your job, if you think you're going to lose your job. You don't go out buying these big housing investments. So these are keenly awaited. We have the new home sales, we have housing starts, mortgage approvals. All these are basically showing you what's happening to the housing market. If people are buying houses, they're more confident in their jobs, they're earning more money, inflation goes up, central banks may have to act on interest rates. You're getting the picture, I hope. Okay, the other thing I want to mention here is QE, quantitative easing. Over the last few years, you may have heard this expression, certainly the last couple of years, or certainly since the recession 2008, central banks have been flooding the markets with money, basically be buying bonds and putting money back into the system, more money in people's pockets so people can go out spending, what have you. Now, the economies are now not providing so much QE. There's a wind down, if you like, of QE. Markets are looking at that as well, always looking for the central bank's view on QE. Are they going to be buying more bonds? Are they be putting more money back into the economy? And of course, that affects how much money is swashing around inside the economy. Again, all affects inflation and people's spending habits. Throughout the calendar month, we always see the central bankers, they like the sound of their own voice, they're always on the news wires. The speakers, they're always coming out, making comments, giving interviews to whether it be CNN, CNBC, Bloomberg or what have you. They're all giving interviews and we're all looking for hints, for clues, what the central bank speakers are saying about interest rates. Maybe because when they get to vote every month, we know which way they are going to swing. And of course, when it all comes down to the vote, we're looking to see if they ultimately move interest rates or not. If they move interest rates higher, generally speaking, the currency should go up. If they move interest rates lower, the currency should go down. But again, it all does depend on market expectations. Throughout the month, you'll often see analysts, they give their projection of what this data will be. And we look to see if the actual result, the actual data release, exceeds their expectations or indeed does not meet their expectations. So we're looking at the analyst's view and then seeing the release and acting on the release of that. Okay, so these are the basic economic indicators that we look at on a monthly basis to give us clues on where the central bank may be moving on interest rates. And as I said, where interest rates go, the currency tends to follow.